First data slide shows inventory is essentially normal. It's 102% of normal. That's as close as normal as you can be. We did have a surplus of inventory earlier this year, but basically it's off the chart now. It's more than 13 weeks ago. We basically have normal level of inventory. Offers accepted, you can see we're still floating around the blue line. The blue line is the least number of offers you'd expect. Right now, we're at 85% of the offers you'd expect. So we're still missing 15% of the marketplace out there. That could just be a combination of sellers are in low interest rate loans, no incentive to move. It could be people sitting on the fence. We've been there ever since the 2022 price adjustment that started around Valentine's Day based on my data. Number of transactions, that's the actual number of closed transactions. You can see it's right at the blue line as well. We're basically at 78%. You might wonder how you can be at 78% and 85% when an offer should close. Well, you have things called transactions that fail. That can increase as the market slows, as the market, is more balanced. More buyers are willing to walk away from a transaction if something goes wrong. Where if the market's going up, the fear of increased price cures a lot of escrow problems. But it's not uncommon. There's also a lag time too. So you have to go back and say, what was the percentage 5-6 weeks ago on offers accepted? It could have been lower. But anyway, so you're at 78% of the closings. That's what the industry runs on. Days unsold inventory. This is the supply demand balance, the number of active listings compared to the number of offers accepted. You can see we were quite a bit above the blue line. That means a very slow marketplace. We dipped down about 5 weeks ago to be between the gray line and the blue line. And now we're right on the gray line. In fact, you can't get closer, 100.4%. So your speed of the marketplace is exactly normal. What am I talking about? Normally it's 44.3 days. Right now it's 44.5 days. There isn't a person around in the marketplace that can tell the difference between 0.2 of a day when you're talking about 44 days. So we basically have just over 6 weeks of inventory. It would take 6 weeks to sell all your existing inventory. A similar but different number is how long does it take for 3/4 of the sellers to sell? The biggest difference between days on market and the DUI is days on market only counts those sellers that are successful, where days on sold inventory includes those listings that are active that never sell. So days on market is going to be a more optimistic number because we're ignoring those for properties that never go into escrow. But anyway, it's still a reasonable metric. You normally are 25 days. You're now currently at 29 days. So it is taking a little bit longer for those sellers to sell, but that's half a week longer. It's 18%, almost 20% longer than it typically does. But that's a significant improvement from the 75% longer than typical just 13 weeks ago. So we've improved 2 days. We've gone from 31 days down to 29 days. And you can see that the purple line is now lower here in the center of the graph on this week than it was 13 weeks ago. But more significantly, you can see you went from above the blue line to below the blue line. The blue line is the favoring the buyers. The neutral line where you actually expect the market to be is right here. And you can see there's some weeks, like another 8 weeks, typical and the blue are very close together, and the hot marketplace is significantly below. So, and 13 weeks ago, it was sort of the other way around. The gray line is very close to the hot marketplace, which means the market's typically hot at that time of the year, and it's hard to get a hotter marketplace. Price reductions. This is a measure of sellers' expectations versus market realities. You can now see that we're at 52% bigger price reductions, but keep in mind that's still a small price reduction. So it's 1.4%. And the reason that number is so small is the vast majority of the sellers do their homework with their listing agent prior to putting their house on the marketplace, and they come on the market to sell. So they're pricing it according to the current marketplace. There are still some people that misjudge. As the number of people misjudge, that's usually an indication that the market's softening. Because if the market's going downhill and you do your homework a couple weeks or a couple days before you come on the market, depending on your style, you then have had that market slow down, and you also don't have the benefit, like when the market's increasing, that the market increases into your misjudged high price. So it still is a valid measure of, is the market hotter or cooler than sellers and listing agents were expecting? Overbidding is on here for more curiosity. It's clearly a lagging indicator because you need to have close price. But again, notice the improvement. You've gone from an ice cold marketplace essentially back here 13 weeks ago to now almost a normal marketplace. So right now you're having a 4.2% overbidding. So if someone's asking $1 million for their property, they're getting $42,000 above that. Normally they're getting $48,000. So there's a little less overbidding on a magnitude basis. You can see at this time of the year, we on a hot marketplace, you have as much as 7% overbidding. But it's also noteworthy, even in a cool marketplace here in Silicon Valley, you have 2.5% overbidding. So it's rare for the median sale price ratio to be less than the seller's ask price in Silicon Valley, which is Santa Clara, San Mateo, and Alameda County. And that's also measuring just the sale price at the time the offer is accepted. Now what we're doing is looking at the three key indicators over a long period of time. The first one is the purple line, the inventory. You can see that the inventory is just slightly above 100%. Black horizontal line is 100%, and each line up here is 2%. It looks like 104 was last week, and 102%, and 2% was this. So essentially normal. And by having the history here, you can see that we had this surplus earlier this year after we had several years post-pandemic of a shortage of inventory. And then before the pandemic, we had a surplus of inventory, and pretty much before that, normal levels of inventory. So you can sort of see the range for your own eyes. I have the 10 years that I use for my 10-year median on here, which is why we go back to January 1st of 2015. Let's move on to offers accepted, which is the orange line down here. You can see orange is about 85% of the normal level. And you can see that that's actually a higher level than we have been for most of the time since February 14th, 2022 price correction. So from this point on, it takes time for the market to respond. So once the market by beginning of July realized the market had slowed and prices had come down, ever since then, we've had this lack of transactions, which has been for a greater duration and greater magnitude than the surplus we had. In other words, most of the surplus was about 20%. Well, the first year you were missing 30% of the market, and then you were missing 20% of the market. And this year it's been more all over the place. And right now we're missing 15% of the marketplace. And you can see that before the pandemic, we were right there. Now, another thing I've noticed is there's a long tendency going back many, many years, all the way back to the early 90s and probably even earlier than that, if I looked at the data, that to me indicates that the number of transactions that we would expect in Silicon Valley every year is decreasing, which is the opposite of what you would expect right off the bat. Because as the valley grows in population, you'd expect more and more transactions. The reverse is happening because the market is becoming more stable. The local marketplace really developed significantly in the 60s and the 70s, and those people would trade homes more often, but now they're retirement age and they're staying in their houses longer. We've also had Prop 13 for a longer period, locking people in, because even with the $250,000 exclusion, you still have significant capital gains tax hit to pay if you decide to move for a lot of people here in Silicon Valley. And then the third one is the days of unsold inventory, and that's in the gray here. And a high number is a slow marketplace. So you can see that, halfway through second quarter, we were at the slowest, and I actually expanded the graph above 70% because it looked like it was going to keep on going. It reversed and it's come back down, and now you're 100%. We're right at normal. So you can see that 2024 was fairly close to a normal year. 2025 was much slower, and now in the last several weeks, the last half quarter, we've been doing this huge improvement. I guess it's the last quarter because now we're into the fourth quarter. Because if you go to the beginning of the third quarter, you're up here at 58% slower than normal, and now you're essentially, I think the number was actually it was 100.4%, so 0.5% slower than normal. It's essentially normal. In fact, the gray line is a little bit above the black line, just so you could see it. And if you look carefully right on the right-hand side, you can see the gray line is below the dotted line. That's just there to give you, it's artificially raised so you can see it. Now we get into my micro market data. I think this is the most valuable stuff. You're talking about Silicon Valley is at 5% of inventory. Santa Clara County is at 3%. San Mateo County has the biggest surplus at 7.5% more inventory than expect. And Alameda County has the least amount of inventory at 99.9%. And you'll notice that for Alameda County, for the first about 5-6 slides, I don't have micro market data. So countywide data is populated. I may introduce micro market data next year using the data I have available, which I think is only 5 years. So it would be on a 5-year basis, which is still somewhat significant. Now you look at offers accepted. This is the same concept. Silicon Valley, 85% of what you expect. Santa Clara County is doing a little bit better at 87%. San Mateo County is doing the best at 95%. So that's getting very close to normal. And then in Alameda County, you're at 80%. But even if you look at San Mateo County, you can see the range goes anywhere from 77% for Foster City, but that's very small. So Atherton at 80%. And if you want to get to a reasonable size normal marketplace, you can go to Pacifica. So you're going from 79% to the coast at 109%, or Redwood City, which is very reasonable area, at 119%. So you have almost a 40% swing on how the market's doing within one county. And that's why it's important to look at data on a local level. And even statistical data, it's to give you a broad brush of what's happening in the marketplace. If you need to know what's happening for marketing purposes, you need to do an individual CMA. Here's days unsold inventory. Here a large number is a slower marketplace. So you can see Silicon Valley is at 3% slower, Santa Clara at 0.5% slower, then San Mateo County 10% slower, and Alameda County 12% slower. So they're all right very close to 100%. And basically you got in order as they are here as far as speed. So Alameda County is the slowest, and this is relative to what it normally is. So that's why I'm comparing it to the 10-year median. This next slide brings in the actual raw count. And now it becomes interesting because look at your areas over here in Livermore and stuff. Livermore is down here somewhere 144 days, Pleasanton 131 days. So that's dramatically slower than Fremont at 34 days. I mean, you just go over this in old grade and you go from 34 days, 1 month, to something approaching 4 or 5 months. So there's a huge difference in a very short drive on 680. You go into Hayward, 35 days. Now Oakland is at 75 days, but right next door with the island of Alameda and Berkeley, you're at 40 days. So again, it really shows the difference. Same thing in Santa Clara County. You know, you can look at the affordable areas at 55 days and then go to the moderately affordable areas at 28 days. Or you go to Cupertino, Sunnyvale, sort of the moderate expensive areas at 28 days. And just down the road, you have Saratoga, Los Gatos at 58, or go north and you're at 36 days for Los Altos, Palo Alto, and look at the huge difference between reasonably similarly priced areas, being Saratoga, Los Gatos, and Los Altos, Palo Alto, 60 days to 35 days. That's almost half or double the speed faster in Los Altos than it is in Saratoga. So it's not price driven, it's market driven. Here's marketing time for the different properties compared to the 10-year market. Now, what's interesting is even though the time to sell the property, the days unsold inventory, was faster in Los Altos, here you're comparing the 10-year median, and it's actually taking longer to sell in Los Altos than it normally does. And in Saratoga, Los Gatos, it's taking half the time. Saratoga, Los Gatos is normally a much slower marketplace. So these are compared to their own individual market. How's it doing compared to the 10-year median? You can see Morgan Hill is slower. You can see the affordable areas that had a very long days unsold inventory is actually going faster than normal at 94%. So you have to pay attention to what metric you're looking at and what you're trying to convince yourself. San Mateo County is at 10% longer than normal, and Alameda County is at 20% almost longer. But now look at Pleasanton. Pleasanton is exactly normal, even though it was at something like 131 days. So Pleasanton is a slow area. Dublin and Castro Valley and Livermore that was roughly the same as Pleasanton is actually 50% longer than normally does. So there's a huge difference in the different metrics, and trying to understand them all, takes a little bit of grasping. Here's the raw counts. So how long is it actually taking? Well, in all of Silicon Valley, it's only taking 29 days. That's not even a month. So probably pretty much anywhere in the country, if you could sell 3 out of 4 sellers in a month, they would consider that to be an unreasonably fast marketplace. Here in Silicon Valley, we say that, hey, we're actually a little bit slow. Let's look at the micromarket data. In Santa Clara County, it goes from a low of 12 days, not even 2 weeks in Cupertino, Sunnyvale, to Morgan Hill and Gilroy at 2 months. So 2 weeks, 2 months, all in the same county. Most of the data, I would say, is right around 3 weeks. San Mateo County, you go from 65 days on the coast to a fast of 15 days in San Carlos. And San Carlos here is at 15 days. Redwood City, that was having more offers, is at 25. So, not every metric is even the same as what you'd expect. And we do have individual micromarket data for Alameda County. So you can see you're at 32 days for the county overall, but it ranges from a slow of 41 days in Castro Valley and Livermore to a fast of 17 days in the island of Alameda and Berkeley. And the color coding here really helps graphically see. You can see that the sort of the West Peninsula area has the shortest marketing time. You can see that the East Bay is sort of normal. Now you're looking at price reductions. This gives you an idea where sellers overestimated the marketplace. And it's really concentrated in the southeast area of Santa Clara County, as well as sort of the Livermore area in Alameda County. So you got a long range overall. It's 97% of what you expect. Santa Clara County, 99%. San Mateo County is taking bigger price reductions at 97%. These would be indicating larger price reductions, and 96%. So here this would be less price reductions. What I'm looking at is the percent of normal you're getting. It's like, so for example, just throwing out numbers, if you're getting 102, 103%, if you're normally getting 85% of your ask price, a higher percent of your ask price would be 100, would be something like 88%, or actually about 80, yeah, about 87%, 88%, somewhere in there, would be 3% higher than the 85% you normally get. So it's not that, it's the percent of the ask price, which is a measure of price reductions. Here's the average magnitude. So how big are those price reductions? You can see they're fairly small. They go anywhere from 0 in Foster City, and there are times when these numbers are actually positive. The biggest number I'm seeing on here is in Oakland at 2.5% negative. Oh, here's Atherton at 3%. So 3% price reduction. The affordable areas in Santa Clara County at 2% almost price reduction. So you can see Silicon Valley overall is taking 1.5% reduction. Santa Clara County is at 1%. San Mateo is at 1.2, and Alameda County is taking the largest price reductions at 1.7%. This is the frequency of price reduction. So how common is it? So overall in Silicon Valley, where it's 10% more common than it normally is. Santa Clara County is exactly normal. San Mateo County is 5% more than normal, large range from 49% more than normal to 82% to Foster City, where no sellers took a price reduction in the last 5 weeks. And so that, you can't get better than nobody doing it because you got division by 0. And then Alameda County has the most frequent price reduction at 17% more than normal, anywhere from Castro Valley at 43% more than normal, Oakland at 59%. Look at this at Hayward and San Leandro at 83% more seller reduction than normal. And then Pleasanton, that was a slow marketplace, actually has a shortage of price reductions. Only 85% of the sellers that normally do a price reduction are doing a price reduction. How common are price reductions compared to the median of 10 years? Here's the actual raw numbers. So you can see Pleasanton, almost a quarter of the market's doing a price reduction. Castro Valley, 33%. You got a range of anywhere from 19% for Silicon Valley overall. The least amount of price reductions is in San Mateo County at 16%. Followed by Santa Clara at 17%, and Alameda at 21.5% of the sellers are doing a price reduction. So that's a little bit more than 1 in 5, but less than 1 in 4 sellers in Alameda County. Santa Clara County is about 1 in 6, and San Mateo County is about 1 in 7, if I'm doing my math quickly on the fly. Overbidding, how common is it compared to the 10-year median? You can see it's pretty much blue in color. There are hot areas like Cupertino and even Campbell where you're getting more overbidding than normal, as well as Foster City, Redwood Shores, and Berkeley. Most of the areas are blue, which means there's less overbidding compared to the normal, and the white areas are basically normal. So where are we talking about? Silicon Valley overall is at 99%. Oops, I got the highlight in the wrong place on this one. Should be down there at Santa Clara County on 100%. San Mateo County is at 99%, and Alameda County is at 100%. So it's actually sort of interesting that Alameda County has more overbidding compared to their normal behavior, and they got the longer marketing times. And I think we'll see a better example of that in a minute. Here's the average overbid. So this is, the average of all the prices, whether they're above or below. Your Silicon Valley is 4% more than the seller's ask price. Santa Clara County at 3%. San Mateo at 3.6%, very close together, 0.3% difference. But look at Alameda County at 5.6%, almost overbidding, even though that it's got the longest marketing time. And I think the obvious explanation for that is sellers are coming on the market, they're testing the market, they're finding out they misread the market, they're lowering their price, they're overshooting the market with the lower price, and buyers are saying, even though you've been on the market for 3, 5, 6 weeks now, we're going to overbid because we're afraid of missing out, the fear of loss, and they're going to overbid to get that property because the seller reduced their price. So, normally you would expect an area that's having long marketing time to have the least amount of overbidding. Not necessarily true at all, which is one of the reasons I look at so much data. Here's the frequency of overbidding. You can see that it's down across the board, 86% overall, 89% for Santa Clara County, 87% for San Mateo County, and 83% for Alameda County. So you can see where the blue is. The blue is up and down the eastern foothills, basically, and the better marketplace, which is still a hint of blue, is on the peninsula. So you can graphically see the difference. And, you can start seeing these difference in micro market areas. You could be right over the line. Now, whether any particular neighborhood is going to be that way, because this group's a zip code based marketing data, and I picked areas where the market tends to perform the same way. There's no practical way to actually define where these lines are, so you have to come up with some artificial border, and it just gives you an idea on what's happening. And again, statistics are for getting a view of the greater marketplace, and a CMA, competitive market analysis, tells you what's happening in any given area. Here now is the frequency of overbidding. This is actually the raw numbers. The previous slide, the one we just finished, was compared to normal. So in Silicon Valley, you're getting 55% of the sellers getting more than ask price. Same basically in Santa Clara County, San Mateo, and even Alameda County. So the frequency of sellers getting more than their ask price is pretty uniform. The least area I'm seeing right off the bat is the coast, at only 29% of the sellers are getting more than their ask price. The area that's the highest is Berkeley, and city of Alameda at 85% of the sellers are getting more than their asking price. That's something like 6 out of 7 sellers are getting more than their asking price. Oakland, that even though it was doing large price reductions, 3/4 of the homes that sell in Oakland sell for more than ask price, 3/4 in Cupertino, Sunnyvale. So there is still a lot of overbidding going on, more than half the sellers overall. And that was down to almost 50% even. I think it got down to like 51.5%, if I remember correctly. So we've improved a little bit in the last couple weeks. Now here's long-term appreciation. This goes back to the last 9 months of 2015, and I think is basically reflective of what we saw with the pandemic. Areas that have a longer commute that are still reasonable became more desirable. So they went up in price, and whatever went up in price most recently tends to have the largest price increase overall because of compounding. And areas that were close to the job centers and up here on the peninsula became less, they aren't less desirable, but buyers were less willing to pay for a premium. So their prices sort of had a lid on them. And you can start seeing that right now in Santa Clara County. You have 107% appreciation. In San Mateo County, it's only 73%. In Alameda County, it's only 69%. But now let's go back and look at Santa Clara a little more closely. 107%, but if you look at each one of these micromarket areas, the largest micromarket area is at 98%. So how can you have a county that has 107% when the best county is only at 98%? You've had a change in the market mix. The areas that are the first 4 areas are basically at or below the median sale price. So if the last 3 areas, Cupertino, Sunnyvale, Saratoga, Los Gatos, and Los Altos, Palo Alto, become a larger percentage of the market share, that raises the median price overall for the county, which is how you get the 107% up here, but doesn't raise the price in each micromarket area. So if you're looking at property value appreciation, these numbers here that are lower are more accurate than what the media would report, because the media is going to report on either Bay Area data typically or countywide data. So they would say that countywide, Santa Clara County has got a 107% appreciation since 2015. But that's not what property values did. That includes the shift in market mix. And I hope I'm making that clear. Same thing in San Mateo County. It's got a 74% overall increase, but the largest individual increase is at 64%. So your overall is 10% higher, and your overall is actually a slight shade of pink, but each one of your micromarket areas is blue. And then Alameda County is a little bit more mixed because you have areas like Fremont and Union City that had a greater than the county-wide average. So Alameda County, you're not seeing that disparity because there may not be a shift in the market. In other words, you have some above and some below, so it's not clear whether you have a market mix shift like it is clear in San Mateo and at Santa Clara County. Here now is the price, and instead of following just the median number, which is the middle number, I follow the cheapest 10 percentile on the left and the most expensive 10 percentile on the right. So you got the extra benefit of a range. So if we take the PITI area, you know the single family homes ranges from 1.2 million to 1.85, and the median is 1,550. So if there's a $350,000 gap here on the low end and a $300,000 gap here, both of those have 40% of the marketplace. So 40% of the homes are here between the 1.2 and the 1.5, and 40% of the homes are between the 1.5 and the 1.85. So you get an idea of how many homes might meet your price range in any given area. Here, the blue is simply the more affordable areas, the red are the more expensive areas, and it's sort of what people will perceive. But it is noteworthy that Cupertino Sunnyvale now is a redder color than Redwood City, San Mateo, and that did not used to be the case. San Mateo used to be more expensive. Here's a summary where instead of alternating, I put all the green together. That's comparing to a 10-year median. So you can see compared to the 10-year median, there's a lot of blue over here. Yes, there are some red in a few select areas, but more of it is blue overall. So the market is slower, favoring the buyer more than Silicon Valley market normally does. But now if you come over and look at the yellow section, that's current leading indicators. It's sort of mixed. The price adjustments is the bluest out of all of them. And days unsold inventory, which is sort of the most leading indicator, is actually the reddest, which would tend to indicate that the market's heating up and getting hot, almost hot compared to normal. Yes, there's some areas that are very cold compared to normal, but we would now have what I would consider to be a normal to hotter than normal marketplace, which is going to indicate the marketing times will most likely come down next. And the longest one to come down is the adjusted ask price. So you're right now indicating you went from a cool marketplace to a hotter and hotter marketplace. Then the two in orange are lagging indicators because you need sale price. They're on here more just because people are sort of curious on what's going. And that's the overbid, the magnitude in the first column and the frequency in the second. Then the overall appreciation since last 9 months of 2015 to present day, and then the price range. Here now is looking at the Silicon Valley overall compared to the 10-year median. So you can see that you're just slightly above where you'd expect as far as normal inventory. And here's on a percentage basis, and I believe that was the 4%, or maybe it was 2% more than inventory, normal inventory, but it's basically normal. You can see you come down from recent highs, you're up from the shortage that we had in 2024. Here's the number of offers accepted. We're still missing quite a bit of the marketplace. You can see you've been closer to the blue line all the way back to basically right here, July of 2022 on, you've been sort of following the blue marketplace. So we've been missing a lot of the marketplace. Here's on a percentage basis. You can see now that you've improved from the 30% missing of 2023, 20% was missing in 2024. In 2025, it's been more volatile. And right now we're only missing 15% of the marketplace. Here's days unsold inventory. You can see the improvement in the last couple of weeks. It's gotten close to the gray line, and right now it's exactly on the gray line. But notice at this time of the year, it normally falls down. So the market, it normally heats up at this time of the year, which is something a lot of people wouldn't expect. And you'd almost expect inventory, the market to slow down as you go into the latter part of the year. What happens is the sellers dry up more quickly than the buyers, and you sort of have a second wind, and that's what tends to pull this down. And you can see that the pattern's the same every year, where it actually improves a little bit on the speed. So now here's your 100.54% or whatever. It's very close to 100%. The purple dotted line is actually higher than the actual data point. If I moved it down, it'd be right on the gray line and would disappear. Here is your marketing time. You can see marketing time improved dramatically in the last couple of weeks, and then this last week it's been flat. No indication of which way it will go next. Normally what you do is you normally look at the trend of the line. So normally you'd have expected days on market to be increasing. So this decrease is a fairly unusual and unexpected improvement in marketing time. So sellers that are more successful more rapidly. Here's marketing time compared to normal. You're right at 20% longer. So that's still a slower marketplace, but it's a whole lot better than the 80% longer ago that we were just at the beginning of third quarter. This is price reductions. This is the largest 10%. This is the metric I actually like because it shows you what's happening. The average pulls in a lot of zeros, so it's harder to see what's happening. But again, you're sort of taking larger price reductions than normal. You're right on the blue line. Here, you were taking even significantly greater. So in the last couple of weeks, you've had this huge reduction in the price reductions that were happening for whatever reason. And that's because probably people are sensing the market improved. Here now is the percent of normal. So you can see you're taking 30% more price reductions than normal at the 10%. This is magnitude. So if you're normally taking a $100,000 price reduction, you'd be taking a $130,000 price reduction. This now is the average. Notice right off the bat, these numbers are very small at 1.4%. So the previous numbers were big because they were the largest price reductions. This is average. So I'm bringing in all those zeros. But again, you can see that it's been following the blue line. You've done a little bit of improvement. There's normally a little bit of improvement at this time of the year. And see the little dip here in the purple, in the blue, sort of mirrors what you saw happen in the purple. What I normally do is pick the line, the historical line that's closest to the purple line to see what I expect the market to do. The same data on a percentage basis. So you're taking a little bit more price reductions than normal. And that's why it's blue and favoring the buyer. Here's the frequency of those price reductions. So it's only 1 in 5 sellers, 19% of the sellers are doing a price reduction. And it's approaching the gray line. Here you're very close to the blue line. So I would expected the line to continue to increase. Instead, the market turned and improved, and it's sort of following the pattern of the gray line. So you never know what the market's going to actually do. Here's on a frequency basis, you're 20% larger, 20% more sellers are doing a price reduction, which favors the buyer. Here's the magnitude of overbidding. You can see you got down to almost right at seller's ask price, and then you've improved the last couple of weeks here. Remember, this is lagging indicator, so this is what happened 5 and 6 weeks ago. plus another 2 and 3 weeks ago. So 10 weeks ago, the market started getting more aggressive and there was a little bit more overbidding. Here is on a compared to the actual raw count. This would be exactly normal. So you're about 0.5% below the normal amount of overbidding. If I remember correctly, the numbers were something like 4.6% to 4.2%. So we're taking almost we're getting almost the normal typical amount of overbidding. This is the frequency of the overbidding. So you have, if you were on this gray line, that's 50%. So right now you have something like 56% of the sellers getting more than their asking price, because this is raw count. The gray line is the normal amount of overbidding, which would normally be somewhere around 65% of overbidding. And now you're down around 56% overbidding. This is compared to typical. So you're getting about 85% of the normal amount of overbidding. And here's my price model. The more accurate is the two-step, where you have 12.1% appreciation for 7.5 years and 0% for the last 3.5 years. Now we're looking at inventory for the three counties, being Alameda in the gray, Santa Clara in the blue, and San Mateo in the orange. Right off the bat, you can see San Mateo basically has record high inventory compared to the past 10 years. Santa Clara County is still short. It's higher than it was post-pandemic, but it's definitely lower than it was back here in pre-pandemic years. And then Alameda County is pretty close to what I would consider pre-pandemic levels. You know, it might be a little bit low, but it's pretty close. The downward trend in all three counties is the same. They all came up and did this little bit of a U. This is offers accepted. Santa Clara County is selling more offers, accepting more offers than Alameda County on less inventory. So Santa Clara is going to have a faster turnover rate. San Mateo County, you can't tell right off the bat. It has a little bit lower number of offers than it did back here pre-pandemic. So it's going to have a slower turnover rate than it normally does. And here is that turnover rate as measured by days of unsold inventory. So now we're doing the days of unsold inventory, which is the measure of the turnover rate. You can see all three counties are down, which is an improving marketplace. The lower the number, the faster the turnover. Alameda County has the longest turnover rate at 52 days, followed by San Mateo County at 42 days. And then Santa Clara County has the fastest turnover rate at about 38 days. This is marketing time. This now is a measure of how quickly it takes 3 out of 4 of the successful sellers to sell. Notice the downward trend in all three counties. Notice that Santa Clara County is the fastest, followed by San Mateo, both right around 26, 27 days. And then Alameda County is the slowest at 32 days. The biggest difference between days on market, the 75th percentile, is that not only is it not the overall market, it's the higher quadrant, the fourth quadrant, but it also doesn't count those sellers that come on the market or on the market and then go off the market without selling, because they've never had an accepted offer. So they don't, this only counts those sellers that are successful in selling. So the number, the turnover rate, not the turnover rate, but the magnitude of the number you'd expect to be lower for 3 out of 4 sellers. This is the price reduction that the sellers are taking. So this is actually the ratio between the list price and the sale price. So 98.5 means they're taking about a 1.5% price reduction. So Alameda County is taking the biggest price reductions. You can see that those are increasing pretty much all year, except for, notice that Santa Clara has turned around and San Mateo has potentially turned around. So 2 of the 3 counties have turned around. Alameda County is still increasing. This would suggest that the market improvement that we were seeing on the measured by the days of unsold inventory has actually now reflected in lower price reductions in Santa Clara and San Mateo counties. This is the frequency of those price reductions. So how common is it? Notice in Santa Clara and in San Mateo County, it's going down. Santa Clara was the first one to start going down. And then a couple of weeks later, San Mateo went down. Alameda County, I would still call flat, but it could very well be on a slightly downward trend. Clearly, Alameda County came up and it hasn't dropped yet significantly, but you might say it's rolled over. But both Santa Clara and San Mateo County have now dropped. So fewer sellers are starting to reduce the price. So again, the improvement in the marketplace, it probably started really happening in earnest for third quarter. Is to the point now where fewer sellers are taking price reductions. Here's the overbid magnitude. Now, notice about halfway through third quarter, and there's a lag time for close of escrows to occur. So the lag time here is probably right around the third quarter, the amount of overbidding increased. So again, most of third quarter, we've been seeing an improvement in the marketplace. Frequency of overbidding, how common is the overbidding? Again, it happened right about middle of third quarter. If you subtract off the 6 weeks to get back for escrows to close, you're basically right around the first of the quarter, maybe 1 week or 2 weeks into the quarter, but clearly increasing, not a huge increase, but all 3 counties are up. All 3 counties are, somewhere between 2 and 6%, 2 and 8% higher than their bottom of the market, the least amount of overbidding. Santa Clara is the biggest. It's gone from 48% to almost 56%. So that's about 7.5% increase in the amount of overbidding in the frequency. Long-term appreciation turned around, bottomed out on price. Looks like we're starting to go back up in all three counties. Santa Clara County has seen the most market appreciation. But again, I explained earlier in this presentation on how that has a lot to do with market mix. Here is the sold price. You can see sold price has gone up in all three counties the last couple of weeks. Not dramatically, but it's definitely a turn, more noticeably in Santa Clara County, very clear V, noticeable in San Mateo with a U. Alameda County is still in the noise level, but I was most likely going to start going up, or at least not down. Here's the same information on regular paper. You can see there's about a $15,000 difference. I believe the number is 2 million exactly for this median sold price for San Mateo County, and 1.985 for Santa Clara County. Alameda County looks like it's about 1275. Here's an estimated payments, assuming the national average for high balance conforming loans. You could get a lower interest rate by borrowing jumbo money, as most people do in Santa Clara and the San Mateo and Alameda counties, and also by having relationship banking with your IRA stock investments or your 401k investments. And you don't even have to liquidate it, but it does have to be in the investment company that the lender you're using for your loan. Here are the key chapters. Each one of these has a timestamp in the YouTube description below, so you can jump to the sections you find most interesting. The graphics are a representative chapter image from that chapter. So if you've been a repeat visitor, you can find the sections you like the most. Here's how you participate. We've been talking about Silicon Valley. We will be talking about the greater Bay Area next, 13 counties and 5 regions. The blue URL takes you to the YouTube archive. The green URL takes you to the same place, just less typing. The blue's there for those that don't like secondary typings. If you'd like to join the presentation Saturday morning live at 9 a.m., just use the Zoom meeting here. The password's built in right here. If it asks for the passcode, it's up here for you to enter. If you want the handout, which is posted, you can type in the green root URL, the year, month, date that you're looking for. So it would be the green root URL, the letter H for handout, 2025, 10 for October, and 04 for today's date, October the 4th. If you want the direct link, here it is for October the 4th. I only update this every couple of weeks. If you ever want the current handout and you don't want to type in the secondary link, just send me an email. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. Happy to discuss your real estate needs or statistical needs or questions about the market or real estate in general. I'm happy to help out. Now we're looking at the first 3 distributions. So this is still just Silicon Valley. The first distribution is days on market. How long is it taking the sellers to sell? You can see here is the median. So you can see there's very little change in the median price. I'm up here and I follow the 75th percentile, but you can really start seeing there as you go up in these percentiles, you get more and more change. Above 85%, you can see some of these lines get really steep. So that's not representative. And you can even see all the way down to about 75th percentile. So I'm pushing it a little bit, but it's only about 2 weeks where these lines get improved. And that happens when the market's rapidly improving. So if I had to do it all over again, I would probably pick the 80th percentile. But 75th percentile is the 3rd quadrant, 4th quadrant. It's border. It's got a lot of statistical significance. So a lot of statisticians use it. That's swayed me to the 75 percentile. So what we're going to do is we're going to start off on the dotted line. And you can see the dotted line is hotter than it was on the purple line, which is the current year. But we're starting on the dotted line. We're going 1 week at a time for 5 weeks. Then we jump 2 weeks at a time. And then the last 5 weeks are 1 week. So let's start through. You can see the market just bouncing around at this time of the year, not really moving very much, bounce up and down. There's up. So now it's probably slowing down for the end of the year. Now it's rapidly slowing. There's the slowest for the year on December 20th. The January 3rd is also very slow. Now it's rapidly improving. You see the steepness of the line. There's the hottest the market got, which was March the 1st. And then you're starting to slow down already. It doesn't stay hot very long at all. You're slowing down, going up in time all the time. The closer to the blue line, the slower the marketplace. But now look, you're right about here, you're going to have another peak, and now you're actually improving a little bit and to bounce. And there's the peak in the last 3 weeks. It looks like there's been down. So there's been an improvement, a noticeable improvement in the days on market for the last 3 weeks. Same concept for the largest price reductions. By the largest, we go from the 97.5th percentile here down to the 82.5th percentile over here. So it's the top end. The very top end gets dropped off for statistical anomalies. The bottom end gets topped off, because you can see for most of the time there's 0. Even a year ago it was 0. Now recently there is some price reductions happening at this 82.5 percentile range. But we'll step through and watch what happens. You can see there's basically bouncing going on. Now you're going towards the end of the year where things tend to cool off. Right there was a big jump. And there's the coolest that you are on December 20th. By January 3rd, it's already improving. There's the hottest the market ever got. And I think next week's the same. Those two lines look very similar. And then it starts cooling off. So 2 weeks at the peak of the marketplace before you rapidly cool off. That's why we have such a short-lived, superheated marketplace. And now we're bouncing. There's looks like the low, and now a little bit of improvement, another improvement, another improvement, little degradation. That's probably about where we're going to start really improving. So there's been some bouncing. We're at the high end of that bounce rate at the moment, is what I would say that we're at. And the third and final distribution is overbid. This is the distribution of how much buyers are overbidding. And unlike price reductions, this happens across the board. So we throw out the top 5% and the bottom 5%, and we're looking at 90% of the marketplace. The median is somewhere right around here, around 2% over the ask price. And then as you get to the higher end, you can see some people are spending as much as 30% over the seller's ask price. And on the low end, it's much tighter. You're within 10% of the seller's ask price for 95% of the transactions. And it really does drop off. A lot of times this is because buyers wait for the seller to reduce their price and opposed to going in and offering a lower than ask price offer. Anyway, let's step through. Here you can see where it's going. Now remember, this is sale price, so that's lagging behind by about 5 weeks. So you're bouncing quite a bit. You're really not moving any direction. Now you're finally going down towards the end of the year, cooling. Right about there is the bottom of the market on January 31st. Huge improvement, another huge improvement. That's the peak of the marketplace. March 1st, so only a month of February is the only thing that was really at the peak. Spent a couple weeks at the peak and then it came down. Part of the reason sale price spends a couple weeks up there is some people, buyers go quick close of escrow, some go long. So it spreads out the market. There's sort of looks like the bottom of the marketplace on August 30th. And now you saw a little improvement, a little more improvement, a little more improvement, a little more improvement, and a little more improvement. So basically for the last 5 weeks, we've seen an improvement in the amount of overbidding, an improvement in favor of the seller. Here now are the raw numbers of offers accepted. Notice up here, we were the 9th slowest year out of the last 10, the 24th out of the last 25th. We've really improved. Now we're only the 7th out of the last 10, and we're the 21st out of the last 25. So there's been a significant change. And look at the magnitudes, 1,800 to 2,100. That's all, somewhere approaching a 10% improvement in the marketplace, 1,800 to 20, almost 2,200, well, almost 1,900 to almost 2,200. So improvement of 300, and 1824 to 2139. So again, an improvement of 300. Up here, the improvements were sort of the same magnitude. It's just that we've had fewer years with the low numbers. Here now is the raw numbers for Silicon Valley overall, Santa Clara and San Mateo and Alameda individually counties. Notice inventory is up across the board, about 5% in most of the counties. At the same time, the available listings went down. Offers accepted, you can see there's been a decrease in Santa Clara County, a small increase in San Mateo County, and a decrease in Alameda County. Overall, there was a decrease of almost 2% of the offers accepted. Days unsold inventory overall improved because of the huge improvement in San Mateo County, largely caused by their improvement in the number of offers accepted. Santa Clara County saw a slight increase in the DUI, which is a slowing of the marketplace, and Alameda County saw a slightly bigger decrease, which is an improvement of the marketplace. Here's 3 measures of days on market. You have the median 13, 12. Sounds like the market's on fire and really not much of a change. And also a true median, you'd only do what's on the market, so it's whole integer steps. Average is going to have fractional increases and decreases because you're taking an average of a bunch of numbers. And then the 75th percentile, again, is going to be a whole digit number because you're looking at the time it takes 3 out of 4 sellers to sell. But you can see that the 3/4 number across the board is the highest number out of the 3 metrics. All 3 are measuring the same thing. It's just a matter of which one do you feel is more reflective. I like the 75th percentile because it doesn't have a negative. The negative of an average, if one property sells after being on the market for a year, it really pulls up the average for that one property. Price adjustments, overbidding here, you can see the overbid in each county. You have both the median, which is 0.5% for Santa Clara County, but 3.3% average. You can see the average overbidding is really significantly higher than the median. The median's the midpoint. Then the frequency of overbidding right around 55%. Appreciation since the last 9 months of 2015, as well as over the whole 2020 calendar year. Now we move on to the Greater Bay Area, 5 regions, 13 counties, as listed above. We've been talking only about Silicon Valley up to this point. Here are the 5 regions. Notice that inventory is sort of rolled over. Big decrease in Silicon Valley, modest decrease in the North Bay, rollover in San Mateo, and looks like a very recent rollover in the cities. Here's the offers accepted. Notice the trend is up in all 5 regions. A little bounce down this last week, but the trend is up in Silicon Valley, up in North Bay, up in the Central Valley, up in the cities, and slightly up in the Central Coast. But notice how stable Central Coast tends to be on offers accepted. Look at the decrease in the cities. It's gone from 70 days here only a few weeks ago down to 50 days. That's an improvement of 20 days. That's pretty significant. Look at Central Valley. It's gone from 105 days down to 80 days. North Bay has gone from something like 114 days down to 80 days. Central Coast has gone down from somewhere around 107 days to something like 90 days. So everybody's decreasing. So we have a broad brush improvement in the real estate market in the Greater Bay Area. Now, marketing time down dramatically in the cities, still going up in the Central Valley, sort of maybe leveling off in the North Bay and in the Central Coast, but these are sort of a little bit lagging. A significant improvement in Silicon Valley compared to the other 3, but nothing compared to the cities. The cities, San Francisco and Marin, has done a dramatic improvement. It's gone from 60 days to 30 days. They've cut their marketing time for 3 out of 4 sellers in half. Here's the price reductions. You can see Central Coast is doing the largest price reductions. And if you look across the board, Central Coast is almost always at the bottom. The blue's sort of on the bottom of the line. Conversely, the purple is near the top, which is Silicon Valley, and it's at the top. Right now, the cities is very close with the same at about 98.6%. So that's about a 1.4% decrease in the ask price. Central Valley's popping out at 2.2% decrease. And then North Bay is at about 2.6% decrease. Central Coast being the most at 3.2% of a decrease over the seller's ask price at the time the offer was accepted. Here's the frequency of price reductions. You can see cities in Silicon Valley have very little price reductions. Less than 1 in 5 sellers reduce their price. The other 3 regions, being the Central Valley, North Bay, and the Central Coast, are very close to 2 out of 5 sellers. So double the price reductions as far as how common they are. Here's the magnitude of overbidding. The cities has the most overbidding at almost 7.5% over the seller's ask price. Silicon Valley is about 4.5%. The other 3 regions are below 100%. So on average, North Bay, Central Valley, and Central Coast take a price reduction, with the Central Coast being 2%, and Central Valley being 1%, and the North Bay being about 1/4%. Here's now the frequency of the overbidding, fairly similar order. Cities is the most at 60%. That's 3 out of 5 sellers. Silicon Valley at about 55%. Then you jump all the way down to North Bay at about 34%. And then you're at 30 or 28% for the Central Coast and Central Valley. Central Valley is the 28. Here's the long-term appreciation. Notice the cities is doing the worst. That's something that's related to the pandemic. Again, people are not willing to pay premiums to live in the close to work job centers with more remote working going on. Here, the other regions are fairly close together. The North Bay is sort of interesting. You would almost expect it to have one of the higher appreciations. But one of the things we talked about early in this presentation was some of this is market mix, because Silicon Valley is showing in 85% appreciation, and I would suspect that the property values have gone up less than 85%. The reason you have 85% regional appreciation is a shift in the market mix. Here's the sale prices. You can see there's been a significant increase in the last couple of weeks in the cities, San Francisco and Marin. It went from being less expensive to buy in San Francisco and Marin, and then Silicon Valley, to being more expensive. And then you have the Central Coast. Central Coast is a little bit more volatile, in part because you have either expensive homes along the coast or less expensive homes along the 101 corridor. North Bay very constant. Central Valley probably the most constant at probably somewhere around 530 or something like that, 530,000. Here are the estimated payments. They're going to be in the same order, because I just go through a mathematical formula using high balance conforming loan limits for the nation, and 80% loan and estimate for property tax and insurance. Here are the raw numbers for the regions. You have each county in the bold. You have the 5 regions. In addition, I've added in the Bay Area because the media talks about it, but I believe that this is pretty much a garbage number, as is even a county number. I believe you really have to look at the micro market data. With that, see if there's any questions. Again, these are the chapters you can go to in the YouTube chapters, and I'm Richard Calhoun, Creekside Realty. Appreciate likes. My contact information is at the bottom of every slide for you. And that should conclude it for the week. Have a great week. Take care. Bye for now.